Have you ever wondered about the different investment options available to you? Well, you're in the right place. We're about to embark on a journey exploring the diverse world of investments. The importance of investing cannot be overstated. It's not just about making your money work for you, it's about securing your financial future, achieving your financial goals, and even making a difference in the world. In this video, we will be discussing 4 primary types of investments: stocks, bonds, real estate, and mutual funds. Each of these options has its unique characteristics, benefits, and risks. Stocks, for instance, offer potentially high returns but come with significant volatility. Bonds are seen as a safer route, providing regular income with lower risk. Real estate, on the other hand, is a tangible asset that can provide both income and potential appreciation. And then we have mutual funds, offering diversification and professional management. So, are you ready to learn more about these investment types? Stick around as we dive deep into each of these investment types to help you make informed financial decisions. First on our list is stocks, a popular choice among many investors. Let's take a closer look. Stocks, also known as shares or equities, represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company and becoming a shareholder. This ownership entitles you to a share in the company's profits, usually in the form of dividends, and gives you the right to vote on certain company decisions. The value of your stocks can rise or fall based on various factors, primarily the company's performance and the overall market condition. The potential for high returns is one of the main draws of investing in stocks. Companies can grow, sometimes rapidly, leading to significant increases in stock prices. Investors who bought stocks in successful companies early on have seen their investments multiply many times over. However, the flip side is that stocks can also be risky. If a company performs poorly or goes bankrupt, its stock price can plummet, and investors can lose some or all of their initial investment. The stock market as a whole can also be volatile, with prices fluctuating daily. So investing in stocks isn't just about picking any company and hoping for the best. It's about carefully researching and understanding the company, its business model, its financial health, and its growth prospects. It's about being patient and staying the course even when the market gets rough. While stocks can provide substantial returns, remember that they come with their share of risks and should be chosen carefully. Next, we have bonds, often considered the safer route when it comes to investments. But what exactly are bonds? Imagine lending your money to a friend, a company, or even a government. In return for this loan, they agree to give you your money back after a certain period, plus a little extra as a thank you for your trust. This is essentially how bonds work. When you buy a bond, you are essentially loaning your money to an organization for a fixed period of time. In return, they promise to pay you a fixed rate of interest, also known as the bond yield, during the life of the bond, and to repay the principal amount you invested when the bond matures or reaches the end of that period. Now, why are bonds often considered safer than stocks? The main reason is that the interest payments from bonds are typically guaranteed, meaning that even if the organization's performance fluctuates, your returns stay the same. Plus, if a company goes bankrupt, bondholders are repaid before stockholders, making bonds a less risky investment. However, it's important to remember that while bonds are generally safer, they also usually offer lower returns than stocks. Therefore, they might not be the best choice for everyone, especially those seeking high returns in a short time. In the grand scheme of investing, bonds provide a counterbalance to the riskier stocks, offering stability and predictable income. They can be a great addition to your portfolio if you're looking for stable income with lower risk. So while the road of bonds may be less thrilling, it's often a steady and reliable journey to your financial goals. Now, let's move on to real estate, a tangible asset that many find appealing. Investing in real estate is a popular choice because it offers the potential for passive income, tax advantages, and the appreciation of property value over time. Imagine owning a property, whether it's residential or commercial. You can earn a steady stream of income by renting it out. The income generated can often cover the costs associated with property ownership, such as mortgage payments, property taxes, and maintenance costs. And if you decide to sell the property later, you could potentially profit from its increased value thanks to appreciation. However, real estate isn't a guaranteed win. Like any investment, it comes with its share of risks. Market conditions can fluctuate and property values can go down as well as up. Additionally, owning a property involves responsibilities. You'll need to manage your property, which can include everything from routine maintenance to dealing with tenants. And let's not forget about the potential for unforeseen expenses such as major repairs or the possibility of periods without tenants, during which you would still be responsible for costs like mortgage payments and property taxes. Yet, with careful planning and management, these risks can be mitigated. Many successful investors tout real estate as a key component of their investment portfolio, and with good reason. Real estate can be a profitable venture if you're ready to handle the responsibilities that come with property ownership. Finally, we come to mutual funds, a popular choice for those seeking diversification. Now, you might be wondering, what exactly are mutual funds? Well, think of them as a basket of various investments like stocks, bonds, and other securities. Instead of putting all your eggs in one or two baskets, you're spreading them across many. This is what we call diversification, which can help mitigate risk. The beauty of mutual funds lies in their ability to provide access to a wide array of investments that you might not be able to afford individually. They are managed by professionals who make investment decisions based on extensive research. This expertise can potentially lead to high returns, making mutual funds an attractive choice for many. But as with all investments, mutual funds come with their own set of considerations. One of these is the associated fees. These can include management fees, transaction costs, and others that can eat into your returns over time. It's essential to be aware of these costs and factor them into your investment decisions. Another consideration is the risk of market volatility. While diversification can help spread the risk, it doesn't entirely eliminate it. The value of mutual funds can fluctuate based on the performance of the underlying investments, so there's always a potential for loss as well as gain. Mutual funds offer a way to invest in a diversified portfolio, but it's crucial to understand the fees and risks involved. To wrap things up, let's revisit the key points we've discussed today. We explored a variety of investment options, starting with stocks. They offer the potential for high returns, but come with a level of risk and volatility. Bonds, on the other hand, are generally safer with fixed returns, yet they yield lower returns compared to stocks. We then delved into real estate, a tangible asset that offers potential income through rental or appreciation. However, it involves significant upfront costs and isn't as liquid as stocks or bonds. Lastly, we touched on mutual funds, which provide diversification by spreading investments across a variety of assets. The risk and return in mutual funds depend on the underlying assets, and they offer a convenient way to invest, especially for beginners. Remember, the best investment for you depends on your financial goals, risk tolerance, and time horizon. Always do your research before making any investment decisions.